Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's founder, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He is not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thanks very much, Carolyn. Every month, we look at the latest economic data to see what they can tell us about real estate markets, where they are, and where they may be headed. Our underlying premise is that you make better investment decisions when you have a better idea of the economic forces that affect supply and demand. In order to get a grip on real estate markets, we first have to see how the economy is doing, because that tells us how strong the demand for real estate will be. Here's one way to look at the economy. This chart shows the increase in the number of jobs every month compared to the same month of the previous year. The latest data point is for November. I like to look at the economy this way instead of gross national product or retail sales or industrial production, because the increase or decrease in jobs leads directly to more or less demand for housing. The chart shows the end of the pandemic recession in 2021 and a surge of rehiring in 2022. But then a steady trend towards slower growth. This level of growth is still respectable at just under 2%, but I'm pretty sure it's going to go a lot lower. Here's one reason: the growth of jobs in manufacturing. Manufacturing is no longer a major sector of the economy, but the downward trend we see here isn't due to jobs being sent overseas. Those have already gone. It's mainly companies making things for the US market. The steady decline to almost zero means that domestic demand is slowing. Another cause for concern is the steady decline of growth in business services. This is one of the biggest sectors of the economy. It provides services that other businesses need, like lawyers, accountants, office cleaning, waste management, etc. It's one of the best indicators of actual business activity, and is now growing at just 1%. One part of business services is providing temporary workers, who could be short-term receptionists or long-term contract engineers. Companies like temporary workers because they're easily hired and easily fired. And for the last year, they've been firing them, which means that the future of their own business isn't looking so bright. Another sign of weakness in the economy is jobs at home builders, which grew rapidly when home prices were skyrocketing, but have now stalled out. Builders may be finishing work they've started, but they don't plan to expand, which means they're having trouble selling their projects. Some other sectors of the economy aren't doing particularly well either. In finance, the growth of jobs in the past year is less than 1%. In retail, there's almost no growth at all. At restaurants, pandemic rehiring has almost come to an end. Before the pandemic, jobs in this sector were increasing less than 2% a year. Now we come to the two sectors that are keeping total job growth near 2%, healthcare and government. Before the pandemic, healthcare jobs increased less than 2% a year. The current growth at 4% is largely due to rehiring at nursing homes. Once these jobs have been refilled, growth in the healthcare sector is likely to fall back to the average of 2%. The other sector punching well above its weight is government. In normal times, jobs in this sector increase less than 1% a year. The main reason for stronger growth now is strong rehiring at the state level, which includes state colleges. Jobs in state government usually increase less than 1% a year, so this surge will soon come to an end as well. What all these numbers tell me is that the actual growth of the economy is closer to 1% a year and maybe less, a level of great fragility where any new shock like the wars in Ukraine or Israel or political instability or the price of oil can shut consumer wallets and produce a recession. That's not the only possible outcome. The US economy may just bump around at a low level for years as it has before, but what is unlikely is strong growth anytime soon. So let's see where this leaves real estate markets. This chart shows the change in home prices every quarter compared to the same quarter of the previous year. The latest data point is for the third quarter of 2023. This is a picture of the home price surge that started in early 2020. I have my own opinion about what caused this price bubble, which completely blindsided me, I have to admit, but whatever the reason, it's now coming to an end. Not everywhere at the same time. Here we see home prices in Atlanta, which was still up 5% in the past year. In Miami, they were up 11%. That doesn't look like a market with weak demand. But in Phoenix and many markets in the West, prices are coming down. Not very much so far, but it sure looks like a reckoning is on the way. After all, the problem isn't that home prices increase so much. The problem is that they increase so much more than local incomes, on which home prices ultimately depend. We can see an ultimate example in Austin, where home prices are down 8% in the past year. Despite the fact that Austin is still one of the fastest growing markets in the country, where demand for homes should be strong. But Austin prices are 35% higher than local incomes can afford. In a lot of other markets, the difference is even bigger. When the readjustment of prices we're seeing in the West plays out in the rest of the country, it could happen in two very different ways. It could be like in Fort Myers during the 2008 recession, when prices dropped as fast and far as they had increased in earlier years. Once realigned with income, prices could then again increase with demand. In this chart, we see annual price changes over a span of 20 years. Or the readjustment could be like in New York City after the financial boom of the 1980s. Home prices never really dropped that much. They just stayed flat for 10 years until local incomes caught up. My bet now is for something in between. Big price drops in some markets, but not nearly as bad as after 2008. And in markets with low growth and low home turnover, the process could drag out for years. Finally, I want to show you my worry about a recession in the next year, which could accelerate the whole price adjustment process. It would cause pain for bankers and provide a lot of opportunities for investors. This chart shows quarterly price changes before and after the 2008 recession. Many people think the recession caused the end of the home price boom, but I think it was actually the other way around, that the end of the boom caused the recession. Remember that consumer spending accounts for 70% of the economy. Before this 2008 recession, as home prices kept rising, a lot of people took out homeowner loans or refinanced their mortgage to take out cash and spend it. This extra spending kept the economy going, but when home prices stopped rising, so did the spending, and a recession was the result. Moving forward to the current situation, a lot of homeowners now think their home is worth 50% more than it was just a couple of years ago, a big increase in their wealth. Fortunately, they have not refinanced their mortgage to take out cash because interest rates are too high, but they still think they're richer, and therefore they're buying lots of things. But if home prices come down in the next year, that will quickly stop. That's it. In this time of uncertainty, it's important for bankers and investors to stay on top of local economic and real estate developments. Local Market Monitor provides the data and the analysis they need with local market reports and Investors Metro analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.